Thank you. And I'll just give a very quick warm welcome to every single one of you who's joining us on this afternoon. Thank you so much. This is going to be a very interesting session. So first in order, I must thank the Caspian debt team. We, of course, Abhishek and Sushant are here and they're going to be our co-host as well. And of course, a warm shout out to Ragini, who is our charter member at Type Bangalore and has been a tremendous support for us. And yes, the context here is while everyone talks about bank loans, people talk about collateral free loans, they talk about equity, they talk about raising from friends, family, but there is also another source and why you can actually retain control of your company by using in a smart way because of venture debt and debt financing. So with that, handing over to our very, very esteemed panel, we have a very good audience as well. So take it away and thank you so much everyone once again for being a very warm welcome to everyone for coming in. And please keep your questions going on the chat so that everyone can we will pay attention to those questions. Though there's a lot of information that's going to be shared. And with this, I would like to ask Sushant, Abhishek, and everyone to start the session. And thank you so much.
Thank you, Vijeta. Welcome everybody to this session on raising debt finance. This session is targeted to startups. And at Caspian Debt, we have provided debt financing, customized debt financing to a little more than 160 startups and social enterprises. We provide debt financing in the range of 50 lakh Indian rupees to about 15 crore rupees through a variety of debt products, which includes simple amortizing term loans, meaning that loans that you can pay over a period of 1 to 5 years, or revolving loans, meaning you draw down when you have a requirement for debt and pay it down when you don't need it. And while we do all of this with a lot of our portfolio companies, we realized that in the initial conversations that we have with the startups, the founders, the head of finance of those startups, there are a lot of questions around why to raise debt, how to go about raising debt. Oh, debt is so complex to raise. And we thought that it will be a good idea for us to share with entrepreneurs or head of finance of various startups to share with them as to what does it take to raise debt, because raising debt obviously enables all startups to blend the debt with equity and create a more capital efficient company, which basically means that you can retain control over your decision making. And it also means that you can retain a larger portion of the financial benefit that your company and your hard work is going to earn you sometime in future. And like Vijeta mentioned, there is always this talk about two extremes. One is equity and the other extreme is bank loans. There is something in between that is also available. What we're going to do today in this session is try to bring that knowledge to you from founders of 3 amazing and very different companies that we've been lucky to work with. And they'll talk about how probably share with you tips and tricks of how to go about raising debt and how to build a more capital efficient company. For that purpose, we have this panel discussion session coming up, followed by an Ask Me Anything session that my colleague Sushant and I will, we will try to answer all your questions. But before that, I want to request Sushant to start off the panel discussion, where we will have 3 very, like I said, founders of amazing companies talk about how they went around the aspect of raising debt, not just from Caspian Debt, from other sources as well, and how did they build a more capital efficient company. Sushant, who's our regional manager, is going to take over the conversation from here on. Sushant, over to you.
Thanks, Abhishek. Hi, everyone. Thank you for joining us. And We have a very interesting mix of panel. We have Anand from Remedio Innovative Solutions. We have Arjun from Edge Networks and Priya from Haber Water. So, before delaying this, I would just like to start off the discussion with Anand on a bit about him and more about Remedio. When did you start the operations? Who are the customers? And when did you raise the funds, basically, right? And why do you raise it?
Sure. Thanks so much, everyone. Thanks so much both to Ty as well as Caspian. I think it's a great question that we are asking ourselves, especially as there are different types of financing that we've had access to, and it would be wonderful sharing both our knowledge as well as what I'm sure we will also learn from both the panelists and others in the audience. So Remedio is a medical device company, and what we are seeking to do is bring eye care closer to the patient. And what that means is if today you're visiting an ophthalmologist and there are a set of eye tests that get done all the way from screening for refractive error, glaucoma, retinopathy, all of those devices we've been able to miniaturize and bring them closer to public health in public health centers. We have our operations out of Bangalore, but sell both in India as well as in the US with transition that's happened where 80% of our revenues used to be from India to now where 60% of our revenues are from the US and EU. Primarily dealing with business to government, business to in India, business to private practicing ophthalmologists as well as to dermatologists and specialist doctors in India. And in the US, primarily to channel partners as well as to insurance as well as primary care centers. So it's primarily B2B and B2G that we focus on. The types of funding and the nature of funding, as a product company, initially we started off where there was a gestation in terms of building a product. So the type of money that we raised there was more grant-based money. And then once we started revenue operations, it was a mix of both equity as well as debt financing that we looked at. And the need for fund was primarily from the point of view of working capital, right? Because it's usually not just-in-time inventory when you make hardware devices. You have raw material that comes in. We manufacture the devices in India. So there is working capital that's needed to help with the cash conversion cycle that you'd have from the time that you get your orders and also from the point of view of holding inventory. So that was one primary reason. And the second primary reason was expanding to actually cater to a much larger geography beyond India that required us to increase the manufacturing lines that we had. So that was the second source of need from a funding perspective, both of which were specific to the debt financing that we raised to take care of those needs. Equity financing for us was more on the commercial side in terms of the growth that we had and to fund some risky business initiatives that we would have in terms of go-to-market strategies. So that's really how we've managed the different types of financing within Remedio.
Thanks, Anand. Then we'll obviously delve a bit deeper into debt usage in the next round. May I request Arjun to share more about him and Edge Networks and the funding journey?
Cool, Sushant. Thank you for the opportunity, and thanks Caspian and Ty for giving us this forum and platform. Just to dive a little bit into the genesis of Edge, it's a 2012 company, sort of born in Bangalore, and lifted its capabilities to deliver to companies in India, primarily based out of Bangalore, and then we started going pan-India to solve a very specific problem: match people to jobs. I think the unique, nature of our proposition is not just matching people to jobs. When you talk about it, you think of talent acquisition. What we do is internally mobilize talent, which means that we allow companies, and specifically in the services businesses where people are billable, entities and dollars to the top and bottom line. It's very intrinsic to raise the bar on internal fulfillment through matching people with skills and competencies in real time, right? And I think the nuances of what we learned when we built, algorithms with natural language processing and looked at having a knowledge graph to make inference, we thought of it as a talent acquisition problem alone, and we thought that was a problem that was worth solving. But what we realized as we built the journey and we were starting to foray into multiple companies, we were seeing that the problem persisted across not just services businesses, but we see it in banks, we see it in high-tech companies, where people are looking to take people from other divisions as soon as they have an opening, primarily because of the paucity of time and the quality of talent in the vested population. The people that are already on board, the people that you've spent time with, the people who learned your business over the last 6 months, over the last couple of years. Why couldn't you mobilize them into different functions, roles, and responsibilities, at the click of a button? Now, that's really what we solve for. We've built unified search. We're able to search for people internally and externally, and we've built, an integrated talent supply chain suite of products that has a talent marketplace, has internal mobility for hiring managers, has talent acquisition for recruiters and hiring managers, and has workforce planning and resource forecasting. So it's sort of got the whole gambit. And we've got close to actually more than 500,000 people on the platform right now, which are employees on the platform, hiring managers, delivery managers, and obviously workforce management groups who are accessing the data to be able to, dive into how they can quantify, qualify, and add value to their businesses. We've had a journey where we raised money from, fortunate enough to raise money from Kalari, Venture East, and Xfinity. But just backtracking a little before that, we raised money from the National Skill Development Corporation. At that point in time, venture capitalists were not too eager to give money to a first-time entrepreneur, and also I'm a single founder, so had multiple aspects to it, as well as I had a CTO who was a BA honors in literature. He didn't have a tech degree. Couple all of this together, and you find funding is very difficult. But having said that, I think when we went past with the NSTC money, obviously we got debt at 6%. We got a grant as well as part of the innovation category. We were able to raise money from Kalari, Venture East, and Xfinity. At that point, when we raised money from Kalari on our first round, I think we came around to understand that venture debt existed. And we were, I think, very blind to the fact of what the value of debt is versus equity. And from a financial planning standpoint, I think one of the key aspects that I still stress upon is the value of taking debt at the right time. Fortunately for us, through the actions and the journeys, we met with Caspian, and we were able to raise debt from Caspian, and that has allowed us, the right kind of working capital, funding at a very timely manner, and continues to persist. I think that's key. Like Anand has clearly said, it is for this working capital that we need to sort of look at avenues of debt versus just equity dilution. And I think that's where we struck gold on understanding what venture debt is, and obviously having a partner like Caspian. I think it's been something that we continue to work on to build more through the avenues that we have with Caspian. But most importantly, I think it's leveraging it at the right time. And we as a business have profited from that, and we will continue to profit. I don't think I'm going to look back on this as a value proposition. So yeah.
Okay. Thanks, Arjun. So, very crisp journey of Edge and, your funding journey as well. Coming to Priya, same question, Priya. Would love to hear briefly about you, Haber Water, and the fundraising journey.
Yeah, thanks, Sushant. Thanks, Abhishek. Thanks, the entire team. So Haber is an AI and an IoT-based company out of Pune. We started our journey early 2017. That's when we got our first round of funding as well. So before that, it was a bootstrap company. What's our product? Our product is called Elixir. It sits in a customer site. So our customers are heavy industries like paper mill or steel factory. And this Elixir, it's an edge computing device. It on a real-time basis controls and monitors the critical parameters for these industries, and also gives them a real-time insight and analytics. So they are able to make those course corrections in a timely fashion, as opposed to, taking a plant shut and, restarting their program, which costs a lot of money. So in turn, what Elixir is doing is, or rather what Haber is doing is, we are ensuring the natural resources that are being consumed are kind of, being done more mindfully. So we save a lot of water and a lot of energy for these industries. So having said this, since we are in a B2B space, there are two things that come to, an immediate thing to solve for when it comes to cash, right? Which is working capital. And like I said, our edge computing device, it's our hardware that sits on at our customers' premises. So, managing these two in a timely fashion is kind of important for us. So equity is expensive. So having the right balance of debt and equity helps in giving extra runway. You don't need to dilute, or you don't need to, even have to go with a lesser valuation. So these are some of the things that, at Haber we look at, and that's how we met Sushant and the Caspian team. So, for startup, it's really difficult to get the debt financing going, because you need to have, if you want to go with the bank, you need certain financial statements for, like, I think, a couple of years, and, all of that, right? So Caspian is someone who kind of is not very rigid on those things. They really see the quality of business, and then, it kind of worked out really well for us. We have, I think it's been 3-4 years, I guess, our association with Caspian. So we have raised 3 institutional rounds so far. And, I think the only need for us is working capital and to kind of manage our hardware, which is an upfront CapEx investment.
Yeah. Thanks, Priya. So I'll continue on that thought and delve a bit deeper into the debt part, right? Because that's the topic we're chatting about. So when did you first raise debt, and how has it helped the business per se?
It's for me, Sushant?
Yes, Priya. I'm going in reverse order.
Okay. We raised the debt when we really did not need the money. Okay. So we got our funding, and that's when we immediately decided to raise debt. And we also structured our operating process in a way that, okay, wherever we are doing our capital investments, we use the debt fund as opposed to equity. And we used equity more from an investment strategy, either expansion or investing in talent. That's how we went about it. What was the second question, Sushant? Sorry.
And so how has it specifically helped the business? You mentioned a very interesting point also, that you really didn't need it, right?
Yeah.
Maybe talk a bit more on that, and how has it helped?
Yeah. See, I have realized that, it helps build a good financial discipline when you have debt and you don't need it. So you have to pay those EMIs. Plus also you can manage your business more efficiently, right? So one is, it definitely builds the financial discipline. And two, we, as the business also becomes more mindful in terms of, okay, which direction are we heading? Okay, do we really need this customer? Is the entire qualification process becomes more healthy. And since we are in a B2B space, our customers typically pay in 30 to 60 days. So it's also that part of managing the cash flow helped us.
So both, I think, capital expenditure and working capital, both.
Yes.
Okay.
And it's a good structure to have, because, it helps us get better valuation in the future when you have that extra runway, and, it just things unfold very healthy. And, it's all, everybody, all the stakeholders kind of are kind of like, it's a good return on investment, I can say, right? Like, we are not diluting, and, whatever funds we are raising, it's in the right direction.
Yeah. So just one question here, Priya. Since you've raised multiple institutional equity rounds also, right? Three rounds now. And so if I remember correctly, debt you raised slightly early stage itself, right? How have the later investors looked at Alexa or Haber Water already having debt, right? Did they have any inputs, positive or negative, right?
See, it's more a positive thing because you get an extra runway, plus you are able to make better choices. They also see financial discipline when, they are looking at an organization, right, as an investment. And that really, really helps, okay? Having that right balance is really good. And it also builds history. Like, for example, with Caspian, we have built history over years. Now, that also makes it easy to go and raise the next debt round with Caspian.
Yeah.
Right. It's kind of like a win-win, right? We get more comfortable, we understand, and Caspian is also equally part of the journey. So they have seen how from our first round to till now, how Haber has progressed. So it gives comfort to Caspian as well.
Got it. Thanks, Priya. So I think very interesting inputs, I hope, for the audience as well. Arjun, coming to you, right? So you did mention that you were kind of oblivious to this venture debt kind of segment, right? You had already spent a few years. So when did you realize that? And was there any specific purpose that you wanted debt for? Of course, apart from cash.
So honestly, I wasn't as smart or savvy as Priya was and is, but I think the idea was when I sort of had money in the bank, and obviously treasury wasn't an issue. When we got our term sheet initially from one of your competitors, we weren't really keen because of the terms in the term sheet and what value that money would have basis the plan that we had. Right, we'd already sort of quantified the plan, qualified it, and also I think we had the misnomer that everything goes according to plan. Didn't realize the value of it until the 11th hour, and at that time it was a difficult situation for us. So as a company, we did take debt on the books, but it was unsecured. It was very scattered in nature. And we had to sort of work through the definition of living another day until we could, prove to our existing investors that we had a business running and we had a model worth investing in, which is what they invested in. And they came back and bridged us around. And then we had the ability to also go back and raise money from Caspian. But at that time, we didn't dilly-dally. Obviously, learned very quickly what the value of treasury is and the financial discipline that Priya talked about. I think that really sums it up. And I think a lot of our companies, or at least the startups out there, should be understanding that financial discipline is probably the one reason why people tend to fail. And financial discipline is not just about managing payroll or managing cost to a degree. It's also about understanding what that means. And you need people competent to be able to guide the business through from the inside. And that is also going to be very critical for businesses to then evaluate options that come up. And those options should be timely, right? So I think where I failed was having the acumen to realize how to weigh out the options and to access the options in time.
Yeah, I think that's a very, very important input. And we have also realized that many of the founders do not have the financial acumen, right? They don't have that expertise and they don't need to also, right? They have their own domain expertise, but having the right set of people then really helps, if they are at early stage. But what you are saying is, and what I heard was, the founders also should have or aspire to have that acumen at least the minimum.
So one is through the sense of understanding how to build a business. I guess people aren't equipped, besides the business model and the aspiration, not equipped with financial acumen, because you're really thinking about technology and sales. These two aspects become very critical, and then you go after it. You're not worried about operationalizing. You're not worried about optimizing. You're not worried about financial prudence at a level where you need to, right? Because you're just going after it. and you tend not to look at the fundamentals of sustainable businesses. And it's writing on the wall, but we tend to miss it. And having competent people on board, at least even from a consulting standpoint, if you're able to contract people who you can't afford to maybe hire on as a full-time CFO, you need to have that kind of thinking to allow you to be able to weigh out the options available. Otherwise, what happens is founders have conversations with venture debt companies, don't understand the value of what they're missing out primarily, and you're trying to convince somebody who's not listening to you, right? Because they're just not listening with a lens that can permeate.
Thanks, Arjun, for sharing this. I think it's visible that's coming from real personal experience.
Oh shit.
Thanks. So coming to Anand, you of course have raised equity, but you have also raised grant. You briefly mentioned, right? And you have also raised debt from multiple sources, right? Bank. So was there specific purpose you had in mind, right, for each of these capital, and how did you go about doing this?
So maybe I'll address each of those different instruments and the time frame when we used each of those. Obviously, a lot of the devices that we make, these come on the base of patents that we have. So the early phase when you're developing the technology is obviously the phase when you may not be the best suitor for an equity player, because that's the time you're building the technology. You also realize that you don't have predictable cash flow, so it wouldn't make sense at that time to take debt. So that's when we looked at grant-based funding in order to prove the concept and in order to develop the product. So that was the first phase, which was the building of the product phase. Because our product essentially is meant for use for ophthalmic screening. So that's the first phase. The second phase, we raised equity capital when we had the product and we were ready to go to market. We had the regulatory and everything taken care of. So equity financing was useful there in order to bring the product to market and put in your go-to-market strategies, and you had the backing of investors in order to be able to prove your business models out. Now, during that process, when that became important for us is we initially were serving a business-to-business market, which is primarily ophthalmologists, independent doctors. And all of a sudden, we started working with the government, where we actually got a pretty significant large order from the government of Kerala, right? So at that time, we realized 2 to 3 things, right? One, your working capital cycle all of a sudden takes a turn where your cash conversion cycles used to be around 60 days. Now it can move all the way to around 3 to 4 months, right? Because it takes a certain amount of time. That's point number one. So at that point in time, it became clear to us that we had a certain predictability of when those cash flows would come in. And second, we had the margins on the product to service the debt. So it made sense for us to take the debt at that point in time. And lastly, this was an interesting point, right? It's not like just because you got a large order, if it's from a private company, then obviously investors would look at it as a manner where your risk is not that high. But when you're selling to government, the risk is pretty high, right? Because what if you don't get the money back? So we realized that rather than trying to go through the process of convincing the investors or raising equity financing, then we were very clear in terms of the fact that we needed to engage the government and we would be able to scale with the government. But we needed the right kind of debt instrument that allowed for us, even if the cost was high, because we knew we had the margins, we had the unit economics worked out for us. So we raised debt financing when there was a significant increase in working capital, the cash conversion cycle, and therefore the working capital that we needed. But where it helped the business is initially we did around 40 public health centers, and now we've scaled in Kerala to around 150 public health centers, and now soon to come down to another 120 that we're going to add. So it helped demonstrate 3 things. One, of course, you are able to get revenues. Second, we were able to prove to investors that you can work with the government and you get the money in. So long as I think what's been talked about in terms of the fiscal discipline is extremely important, where it was not possible for us to necessarily take this risk with multiple B2G players, but you choose one B2G player, work with them, show that you have predictable cash conversion cycle, and you're then able to use the debt in order to help you with your fund requirement then when there was a working capital increase. The impact of that for us was we were able to grow the business significantly. We had almost 40 to 50% increase quarter on quarter, and almost we grew revenues 3x that year. Secondly, it also helped show that you can work and scale with the government, which was very important in the Indian ecosystem, because otherwise scaling in healthcare, I personally believe, especially as we have both an impact angle to why we're doing what we're doing, is not going to be possible at scale unless at some point of time you start working with government institutions and be able to bring these there. So it helped us, the debt financing helped us at that point in time to be able to present that as a model. And lastly, where it also helped is the next round of financing then, as I think Priya also pointed out, the valuation was much higher, primarily because you've been able to have a significant increase in revenues and you actually had repeat orders, right? From the government. So it was about taking a certain type of risk, but maintaining the fiscal discipline where you did your unit economics right to make sure that you're able to service the debt. And the outcome for us was a significant increase in revenue and therefore higher valuations when we then decided to raise the next round of capital to expand in the US, which was made possible as a result of the sustainability that we were able to build with the India operations.
Thanks, Anand. And this is a very nice summary of your journey as well, right? From a very nascent pre-revenue stage when you've taken grant, and of course you've scaled up nicely on how you utilized. Yeah, so very useful. So Anand, I'll just an added question to you, because you mentioned this word, which I think is really key: predictable cash flows, right? So delving slightly deeper into that point, right? And if there are any other suggestions for founders or head of finance on when they should really think about debt, or are there any questions that they should answer? Some inputs on that would be great.
Sure. I mean, personally, I feel that debt financing makes a lot of sense when you've understood the cost structures of the company pretty well. Your unit economics is clear. You know what your margins are, and your ability to service the debt is very clearly known to you. And I always believe that debt is ideal when you have what I like to call certain stickiness of revenues, right? Especially many people prefer equity financing, especially when you are wanting to grow at what I like to call very risky rates of growth. But if you are someone that is looking to be able to build a brand, right? Because healthcare is a brand-driven company and not a segment, rather than a traditional B2C segment. So I therefore felt that the right time to raise debt is when you're clear on your cost structures, your unit economics are known, you have some sticky revenues, which result in predictability of cash flows. So in our case, for example, we knew that the higher margins that we had from our sales in the US would easily fund for the servicing of the debt in India, because it's better off then to grow that way rather than necessarily trying to, at that time, press the button on an equity investment, because you are still proving your business model both in India and the US. And the business models turned out to be very different from the way you would sell in India versus the way you would sell in the US. So I think a certain clarity in your predictability of cash flows, right? And that, what I mean by that is not just a projection that you would make, let's say, to investors, but projections that you're making to yourselves in terms of making sure that you believe in what you have as revenues as well as cash flows coming in. Because at the end of the day, that knowledge helps you in terms of being able to choose debt as an appropriate instrument, because you're able to service the debt. Now, one of the things that I would not recommend, but is using debt to finance your losses in the hope that it gives you the time. Oftentimes may not help, but you getting in and fundamentally figuring out how to get the revenues in, and using debt to service the revenues or get the revenues done is easier rather than buying time with it. I do know that the runway is something that's extremely useful, but the runway makes sense once you know that you are able to service the debt because your revenues are anyway coming in even as you're building the runway. And I think that's extremely critical, especially when you're doing debt financing. And I think your funding needs should be very specific. You need to be able to say that, look, by being able to take this for a certain term and with this rate of interest, you're able to, and this is the point that was raised by Arjun as well, either you're able to, or you're working with your CFO, or you're working with consultants who are able to map that out and say, what does this mean in terms of enablement of new revenues, and therefore the cash from those new revenues and the margin offsets that you need in order to be able to service the debt. That kind of an analysis is important to be done. And by doing that, I think you get to a point where you're able to necessarily grow faster than what you would have if, let us say, you've not been able to source that debt. So those possibly are the three things. One, when you're clear on your cost structures, you know your margins. Second, there's a certain stickiness of revenues that result in a certain predictability of cash flows. And lastly, you are able to grow at a rate that you're able to embrace and put your arms around and say that this is going to result in known cash flows that can increase in valuation, which is much better than a case where you may raise equity revenues to try out multiple different things and end up actually not having that revenue accrual that you may be actually wanting. So those would be possibly the key things that come to mind. The last thing, of course, in our case, which is really unique to us, is we had physical assets, right? At the end of the day, we had stocks, we had devices. So in our case, we also had the fact that we had some physical assets that we were going with. Of course, ours was not based on collateral, but it was at the end of the time, at the end of the day, you knew that you had some physical assets that were being created that even if we were to have a distress sale of those would easily pay off the debt that we had. And that was the third factor that we considered as a backup, because you always need to have a plan B. What if, let's say, your best of plans don't work out? What's your way by which you're going to be servicing this debt? And these are some good things to do either yourself or with someone who's very detail oriented and is able to sort of push you back on some of your assumptions. I think these are some good tips to sort of have that at least I went through in being able to then take the decision and going in for financing, as Sushant pointed out, from Caspian as well as from banks in order to be able to take care of the working capital needs that we've had.
Thanks, Anand. I think that was a lot of condensed Gyan. I think each point has a lot of value. Arjun, thoughts from you on, are there some key questions that entrepreneurs or CXOs should think about, right? Answer to themselves when they're raising debt.
No, absolutely. Just taking away from what Anand said, in terms of, I think one of the key misses that one makes is you have some level of predictability and stickiness, and you have the market opportunity, but connecting the dots to the amount of debt that you require to service what specific need, right? Which means, you want to buy time, you want to service financial losses to bridge a gap, which is not a great idea. But are you servicing revenue? Is debt going to optimize revenue? Right? Is clearly an answer that you should have, versus it being, I have 3 deals on the table and I'm going to do this, and hence it's going to do the math down to the T of the term of what you would agree to pay back in, or what you would need to pay back in, should be calculated, and that math should be the mantra that you adhere to while you're going through that journey. That's very critical, and I think a lot of people miss that very, very easily, because you look at the term, the quantum of the loan, versus the term and servicing it? Because the term, say it goes over 36 months or 24 months. What are you doing over 24 months? And how is your business going to pan out over 24 months? You're not really planning that part of it to equate to this 36 or 24 months, which means that there's a lot of line of sight that you've lost with assumptions of, hey, you know what, I'm going to repeat this technically because the market's out there. So financial planning will allow you to get to a specific, which is necessary for you to build predictability and service the need that the debt provides you with in terms of fuel, as well as service the debt. These two sort of come in collusion, and I think it's very important for financial planning to be at its peak when you're starting to expand your business. So when do you get venture debt? When you're technically expanding your business, taking growth capital, hence you got to leverage the value of debt. But what I think I've taken away from Anand and what he rightly said is you miss the forest for the trees. At some level, you're looking at a very tactical sort of 3-month, 6-month window, and then you miss out on what you intend doing with the debt and what the duration of paying the debt back is, and you're in a fix.
Yeah, no, thanks Arjun. And so this is one last thought from you and Priya both. I would request Arjun you to go ahead first. How do you compare cost of equity and cost of debt?
So, I mean, the maths again on the wall. Debt is always cheaper than equity. And if you don't understand that fundamental, then yeah, you have a lot to figure out. But having said that, I think the mathematics of looking at debt and equity infusion obviously comes with its benefits depending on what kind of growth curve you have. So hence you take a larger quantum of equity based on the profile of the business, stage of the business. But what you also realize is there's a reason why you can't take that amount of debt, because the equity comes as an infusion of capital at that cost. It can range from 24% to 50%, depending on the stage of the business and the growth in the next round. And also it could go above that depending on how you grow. I've heard very successful entrepreneurs say that they missed out on making $1.5 billion because they raised private equity money. If they hadn't done that, they would have made a lot of money. And these are people who honestly brought private equity into India and very successful entrepreneurs. And I just heard this very recently on a one-on-one conversation. So I realized that when you're taking money into your business and the cost of it is not evaluated with the best breed, you also have a need and you do it according to that need. But you kick yourself because you did it by diluting equity versus taking debt. Yes, if you had the option, you would have preferred debt. And that's what I think the mathematic you need to leverage is to do the math on calculating the cost of debt and the cost of equity. And obviously also the math on what options are available to you as an entrepreneur at that time and build through. But again, the options that are available are unbeknown to you, primarily because you don't have the financial acumen. If you do have that competence to be able to understand the difference, then you leverage it even by going and talking to a third party for a fee. But you'll get the straight and narrow and you'll be able to make the choice.
Yeah, got it. So you clearly re-emphasized on having the financial acumen, right?
Because you can't make the difference out. And debt honestly is cheaper, but people look at interest rates and then suddenly balk at it, but they're not realizing that it's static versus equity can be quite, flexible.
Yeah, understood. Priya, so any thoughts on, of course, cost and also any suggestions to entrepreneurs, CXOs on questions that they should answer for themselves, right?
Yeah, see, understanding the unit economics is the first thing, right? And then you can break it down into, okay, where do you want to get this fund from, right? It's also possible that if it's a asset heavy, they can even use the assets as a collateral to, take the fund. So it kind of depends. So understanding how they think about their business model to having a line of sight on cash flows for at least 12 to 24 months, help them make a better choice. Like at least I've always ensured that when we close a funding round, immediately I have a plan to work out, okay, what's the kind of debt that I need? You don't need to take a lot of debt, but you got to figure out, okay, what's the minimum or the range of debt that one needs, right? So it again puts a lot of discipline in the system. I think, both Anand and Arjun have covered everything. So this is the only piece that I kind of want to add.
Yeah, no, that's important. So you talk about unit economics, but also planning, right?
Yes.
Are you planning for 6 months or are you planning for 36 months? That's, I think, that's also very valuable. So before we close this and move to questions from the listeners, I actually wanted to go to Abhishek because Abhishek, in his current and previous role, has evaluated now thousands of startups, right? What makes one good contender for a loan, or what makes one startup more lendable than others? What do you look at? Am I putting you in a spot, Abhishek? You're on mute.
Yeah, sorry about that. No, that's certainly not the case. I think the other panelists, the founders who are on this panel, define what we basically look for when we, at least I consider as good funding opportunities. Because if you look at the kind of funding that Caspian Debt does, and compared to the traditional lenders like banks, so let me just start with that first. So if you look at a traditional lender, typically for funding of in the range of a few crores, no funding is available, at least in India, from the traditional sources without mortgage collateral being available, 3-year profitability being demonstrated, and so on. And at no point of time I'm saying that that's not correct way of providing debt. I think that's a correct way of providing debt. It's just that that debt is suitable at a different point of time. Now here we are talking about making loans without taking mortgage collateral. In some cases, the companies may have physical hardware assets, and in some cases it may be like Arjun's company where there are no physical assets. So in those kind of circumstances, what do you really take as a mortgage collateral? And more often than not, most of the companies that we work with, or the founders that we work with, are first generation entrepreneurs. They don't have a lot of personal assets to offer as mortgage collateral either. So in that kind of a situation, what happens is we have to look at ways of deciding to make a loan without being able to depend on mortgage collateral being available. That's what we need to do as Caspian Debt. And the only way that helps, it makes it easier or possible for us to be able to make a loan in crores to a company without taking a mortgage collateral or waiting for a 3-year profitability, is by looking at the data that the company shares with us. The data on operations, the data on how the company's day-to-day operations are run, how is the internal controls of the company, and those kind of factors. Now, all of these things may sound very boring, but truth is, if you really want to build a scalable company, you have to have a fix. And like all of the panelists till now were discussing about very controlled or a very strict financial planning, and of course you have to have internal controls in place. You have to know what is really going on. In addition to having a good team, a good marketing idea, or a good technology stack. Beyond that, if you really want to scale your company, you may have all of these other things, but if you don't have good internal controls in place, and good financial and planning in place, and good ability to share all of this information with people who will evaluate that, it is very rare that you will be able to scale very fast. So I think from our perspective, or my perspective, because we are lending to companies who may not be profitable at the time of taking a loan, and because we are lending without taking mortgage collateral, What we look at is data that the companies provide.
Yeah. And you also look at uncool things, as you mentioned.
Yeah, I look at, I mean, me personally, I look at the boring things. So tech stack, marketing stack are all the cool things that, typically equity investors value, and rightly so, because they extract value when the valuation of the company or the value of the overall business goes up sometime in future. As a lender, we expect to start getting paid from the next month or probably the next quarter. So our needs are completely different. And like Arjun mentioned, probably the worst thing that you can do is when you consider a debt, you say interest rate. What is the interest rate? The problem is basically, like Arjun mentioned, is that in case of a debt, typically that is known and fixed. When you get into equity, it's unknown and it's not fixed. So you don't know what you'll end up with 3 years down the line when you give an exit. So I think from that perspective, it's by design that we look at the boring things, not the exciting things.
But also, you mentioned boring things build scalable business. So yes, that's very interesting. Without managing internal controls, right? One can maybe build cool business, but maybe not scalable and the business that lasts beyond yourself. Thanks, Abhishek. So very interesting thoughts and discussions. So I would like to close the panel discussion with this. And if there are any audience questions, I think we can take. As a panel, if there are any audience questions to panel, I think we can take. If not, if there are specific questions to debt or Caspian, we can take them up in next 15-20 minutes as a AMA session. I'm just looking at the chat.
I think as of now, the questions are for Caspian debt. But I was while I was listening to it, I was off the video and I was listening to a lot of the things that all the panelists said. For me, after a long time, this has been a really good education and a refresher for me. So I'd probably try to summarize some of the things or things that actually I thought was very interesting. I think Priya mentioned that this very interesting thing that she raised debt when she did not need it. Sounds counterintuitive, but she gave a few good reasons about why she did that, and some of it was, like you said, it builds financial discipline. So it forces you to think, and later on, I think Arjun went into the detail of saying how, as a part of the process of taking debt, you really have to think through the business, and so month by month what you're really doing. In a sense, to me, what it told me was that as a business owner or an entrepreneur, that process itself helps you take a deep dive into your business and run the business better. It in a way kind of symbiotic in some sense. The other thing that I think Priya mentioned was she demarcated the use of equity and debt. Basically used equity for specific purposes and debt for specific purposes, which I think is a great idea. And in a way, she said that wherever there was a working capital requirement, which both Arjun and Anand highlighted, for working capital requirement, use debt. And in case of Priya, because there is a fair bit of hardware involved, and that hardware will definitely result in revenues, she has financed a little bit of the capital expenses for the hardware as well from debt. Arjun highlighted the fact that you need to get somebody with a finance acumen to run the business. At the same time, like Arjun did, I think it's also necessary for the founders, even if you are a non-finance person, to get a little bit of an idea about the finance areas. Of course, it's completely understood that everybody does not need to be a financial wizard. And I admit that a lot of us in the financial world tend to complicate simple things and make it sound more exotic. And I take the blame for that, but we try to make it simpler. So it is always good to get somebody with a finance acumen in the team, and also build a knowledge yourself, and hopefully also find financing partners who don't complicate things as much, who just probably help you just get your job done. Anand, I think, mentioned the point about the fact that he did not raise debt when the cash flows were not, predictable. I think which is very important, because when you sign up to a debt term sheet, you agree on a specific repayment schedule that you're contractually obligated to pay back on. So every month you agree that every month you're going to pay back a certain amount of principal and a certain amount of interest. If you don't have the ability to predict whether you will have the cash to pay that, the debt is not the right option. You should raise equity, is what he hinted at. He raised grants, by the way. So he was one of those lucky people who were able to get access to grants. So wherever grants are available, I think that's also another option of non-dilutive financing. Yeah, I think the other point that Anand mentioned about was being careful about raising debt when you are running low on cash or funding the losses. We do fund companies that are loss making at the time of making a loan, but the reason why they take the debt is because they have a clear revenue path. The gross margins are solid, which actually gives them a lot of cushion to be able to get to the next level by raising the debt. But if you're using the debt to keep you afloat, it is generally a bad idea. You have to be very lucky to get on the other side if you're trying to do that. And lastly, I think Arjun mentioned, if you're considering debt, just looking at the interest rate, it may not be he kind of hinted that it may not be a good idea, but the truth is interest rate is fixed and the cost of equity is quite variable. It may go up to anywhere between 25 to 50%. So I think those are a few things that I thought was interesting. Thank you so much, Priya, Anand, Arjun, for all those insights. At least to me, it was very useful.
Oh, thank you so much for having us.
Thanks, Anand.
Thanks, Abhishek.
Thanks, Anand, Arjun, Priya, Abhishek. So what we'll do is, so we wrap up the panel with this great summary of insights that we had, and we move to the AMA, and there are plenty of questions which are directly for Caspian or they are from debt perspective. So we'll take them right now. Arjun, Priya, Anand, you are welcome to stay for this and feel free to leave the session, right? Thank you so much for your time. I hope it was as amazing for the listeners as it was for us who know you already and still had so many insights to take away. Thank you so much for your time.
Thanks. It was really wonderful.
Yeah, it was really cool.
Yeah, all of you can help us answer the questions as well. So I think the one of the first questions is about, does Caspian debt have any industry? The first question is there a collateral requirement? I'm assuming for Caspian debt's loan, how much percent? The answer is we do not. So we've funded about 160 companies, or more than that, Sushant, I guess. And we normally don't take mortgage collateral. We do not look for 3-year profitability either, as if you are venture capital, institutional venture capital backed. But if you do not have an institutional venture capital backing, meaning you're a bootstrap company, we look for profitability, but still we don't take mortgage collateral. Sushant, the next question is, does Caspian debt have any industry preference?
Yeah. So we prefer investing in sectors that have a higher social or environmental impact. So that's by mandate we do that. So some of these sectors are, for example, food and agri, education and skilling, healthcare, clean technology, financial inclusion, right? So majority of our capital, almost 90% of our capital goes towards these sectors. We also look at enterprises that have a women impact. Either they are serving women as their key customers or they have significant workforce as women. We definitely like those businesses and look at them as well. And apart from that, if there are any asset light startups which have an indirect impact, which they are willing to track, we are happy to evaluate them as well. And we have done that in past as well.
There's a question on ticket size limitations. So we do loans between 50 lakhs all the way up to 15 crores. But typically what we've seen is if you look at all the panelists here, I think most of them would have taken multiple rounds of debt from us. So it's not just one loan that we do. We've got partners who've been with us for 7 years now. People who've taken 12, 13, 14 loans from us. So depending on when you really need the money, we provide debt of anywhere between 50 lakhs to 15 crores. It's not like when you talk to us, we'll always ask you to take the largest amount of money, because otherwise it's a high transaction cost for us. No, that's not how it works with us.
So I so I had a couple of direct messages, which I thought and they had similar kind of query. So the shorter answer is somebody asked, can we get debt at pre-revenue stage? Not advisable, as Anand mentioned, right? Predictable and proven cash flows are really the key for a lender to look at providing collateral-free debt. That is really key. And at least I would not advise you to take commercial debt at that stage. Maybe a softer loan or a grant from family, friends, or government is the way to think about it, but not commercial debt.
I think one other group of questions is what data we look at. So, and Sushant, I'm starting, and you can probably jump in and add.
Sure.
See, basically, what we are trying to figure out is whether the core business that we are evaluating has the ability to repay debt or has the ability to generate predictable cash flows, and is the business well run. The way in which we get a sense of that is, first of all, we would like to understand the background of the promoters and the management team. We want to identify whether the management team or the promoter have the ability to run the business, and that assessment is a little bit of a subjective assessment, but it essentially comes from the information on what their past experience or academic background is. We also don't just depend on only the founder, but we try to look for the second line of management, whether they will be able to support the founder adequately. Because as the business scales, the moment somebody takes debt, typically it's at a time when there is a blistering growth that happens. So is the second line of management able to support the senior, support the founder? So some clear detail on the background and experience of the promoters and the second line of management is necessary. We look for MIS or past historical data of the companies. For the past, most of our companies have been there for at least 3 years. For at least 2 years, we look for past data, month on month, trying to get a sense of what has been the revenue and expenses of this company from time to time. We also try to understand in detail the financial statements to understand what is the typical gross margin of the product. Where is the in future? Where is the company going to make the money from if they're loss making currently? We look at data on the internal controls and processes of the company in terms of, for example, are all the transactions being adequately tracked? Are there people who are looking at the different aspects of, for example, when an order is received, when a payment is made, for when a collection is received? We look for processes, whether to identify whether there is a set process and people to track receivables. For example, is the company regularly creating receivables aging trackers, and so on? Sushant, is there anything else that you want to add?
No, that's pretty much it, Abhishek. So I'll move to next couple of, I'll combine 2-3 questions which are linked to the stage that we look at in and the kind of pricing that we offer. There are 3 or 4 questions around that. The stage in terms of revenue we look at is minimum 3 to 7 crore of annual revenue history. Now that's a range because if it's a pure services company where we evaluate them at a 3 crore kind of annual revenue history, and if it's a trading or distribution with sufficient margins in place, then we evaluate at 7 crore or more. And if it is anywhere between product mix, so that's the range we look at. And we also look at 2 years of operations minimum that a company has already had. So that these are, the basic thumb rules, apart from what Abhishek mentioned, what we specifically look at. So, and that's also linked to our ticket size, because we do minimum 50 lakh kind of ticket size. We have realized that that's the revenue range when it is really meaningful for the startups to raise this kind of debt. Second part is on the pricing and structure. So we offer anywhere between 14% to 17%. Plus there is a 1 to 2% fee, a one-time fee. And we do anywhere between 12 months to 60 months, 1 year to 5 year kind of tenor. We do working capital, we do term loans. We also do venture debt where the coupon rate is lower, but there are small equity warrants where we try to make the remaining income. So that's on the that's brief on the structure and pricing and the kind of criteria we look at. So next question, data. You look, Abhishek has answered. There were a few questions on that. You answered it. One question was, what is the difference between conventional debt, venture debt, and somebody asked bank versus venture debt. So a bank looks at, first of all, mostly only financials information. They might not look at your product and the team and the capability the business has. They are betting more on history, and while we evaluate the future potential that the business has. We don't look at mortgage, banks look at mortgage. Another key difference which I've realized after working for last now 5.5 years with startups and mid-sized companies, right? We are willing to listen. And this we get from founders a lot. You will find it difficult to deal with banks because they have their own criteria, which might not be wrong, but they are not your target segment because they will not be customizing the product for your need, which we end up doing a lot. So that's the brief answer. Anything else which I'm missing, Abhishek, feel free to point it out.
No, I think there was a question around electric vehicles. So I wasn't too clear about what the actual question was. So we do finance companies that make electric vehicles. But the debt is not available at the startup stage, as in on day zero, it is not available. It is available at a later stage, like Sushant was mentioning, because our understanding, and this is how debt should be used, is essentially when you have predictable cash flows, then you can do the financing. One type of debt that is available on day zero is what is typically called project financing by the banks. But in that case, the expectation of the bank would be that there would be a defined project plan, and you would be able to give a mortgage collateral of the factory or whatever that you're building out of the money. So the assumption is that that money is going to be used for building factory, and initial capital investments for equipment is to be brought in. And that is typically larger ticket size that they offer. So you can consider the banks for project financing if you're considering a loan on day zero. At least in our set of companies, I don't remember seeing that option being explored because most of our companies are asset light by design. But that's an option that you can consider.
Got it. So another question from Shrikant is there a structure on the metrics based on which we decide or rate lending? Some of it has been answered. I'll quickly spend 10 seconds on each thing that Shrikant has written because it's very useful. Founder background, definitely. Yes. So we look at founders who have relevant experience in the same or similar industries. We prefer that, but there are many young founders, startups that we have funded who didn't have long experience, but they did spend a few years in the same sectors. So we don't look at a relevant education, but we definitely prefer founders from similar industry and sector background who have the required experience. Another point is VC backed. To give you an idea, 2/3 of the companies that we have funded are VC backed, but then there are these 1/3 companies who have raised very smaller rounds from angels, family, friends, incubators, but they had already scaled up to the revenues that I mentioned, right? So we have been able to fund such companies as well. Presence of an institutional venture capital is not a key criteria for us, as long as the business are self-sustainable and run professionally managed. And how we define professionally managed is does the company have internal controls to manage the financials and reporting, and are there dedicated functional heads taking care of dedicated roles? So that's the summary.
Okay, I think the other set of questions is around where are we present. So we have made loans to companies across India. So we don't have the only limitation in geography that we have is we look for companies that are based out of India. But like you heard, Anand and Arjun, they sell their products abroad. So in that sense, anywhere in India works. We have a physical office in Hyderabad, in Bangalore, and in Delhi, NCR.
Yeah. So one question from Sandesh was, the lot of debt is unstructured in case of a bootstrapped startup. How soon you would recommend consolidating them? And if the intended use of debt is well defined, it may fall below the 50 lakh bracket. So it's a specific question, Sandesh, slightly difficult for me to answer without really knowing the details, but it's not really advisable to have multiple smaller lines from multiple lenders, because ultimately you'll have to manage reporting to them, manage their queries, right, be answerable. So I would say as soon as possible, if you get lender who is willing to put a bigger ticket size, that you should look at consolidating them. My suggestion is at early stage, you should not have more than one or max two debt providers. Somebody was asking how can we reach. So I shared the email. Ragini has also messaged. info@caspian.in is the repayment schedules and coverage ratios. Please. So I'm assuming you are asking how our general repayment schedules look like, Rahul. So as I mentioned, right, so we do revolving loans, we do term loans, we do venture debt loans. So they look quite different from each other. Revolving loans, as the mentions, it is based on whenever the borrower has a need based on any orders or invoice based financing, and they can utilize that accordingly. Term loans can vary from 12 months to 60 months with a lot of customization. We do customization on repayments because we provide some moratoriums for principal repayments. This is primarily to match cash flow mismatches because many businesses we fund have seasonal cash flows. That's where we try to address and customize them if they fit into our overall due diligence.
I think there's one comment that Anand has posted. I think that's interesting. So he's made, he's said a very few kind things for us. So thanks for that, Anand. But I'll go straight to the point, which is going to be useful for others. Is diligence done by Caspian will also help you reflect on your unit economics. And I think that when you're having a debt conversation, this is what typically happens. So during the diligence, you will be forced to think about your unit economics. and this will also help you customize the debt. Banks are a good option for debt once you are consistently profitable as a business and have built assets, and debt linked to LIBOR rates of interest would be good option once you when you are a net exporter. So I think he's essentially talked about the bank sources after you have achieved profitability or in situations where you have net exporting business. So I think those are two things that we should look at.
Yeah. So just after that, there is a question from Rahul. How do you protect your interest in case there is a borrower that default because you don't take collateral? Rahul, good question. But the great
It's
thing
front-ended. It's front-ended. So I can tell you, in all these years of us working with 160 companies, if I remember correctly, only 3 loans had to be written off, and those were in situations where it was completely it was environmental factors that we understood because of which it happened. But basically what we understand is, like you rightly said, that we do not have the ability to fall back on mortgage collateral. Our entire risk assessment is front ended. So the point that I made about asking for data, we ask a lot of questions, and sometimes people like Anand take it positively. He uses it to kind of think through his business model and unit economics. But sometimes a lot of people wonder why we are asking so many questions. And the reason why we ask so many questions is because we don't have the ability to fall back on mortgage, but we want to support professional entrepreneurs. So I would say we protect our interests by asking a lot of questions upfront.
Yeah.
Abhishek and Sushant, there's one thing that I want to tell everybody on this call, okay? So the way I see Caspian, right, they're very pro-business, very supportive. It's not like they're very rigid in the way they go about things, right? So you can really express your concerns, and they're very, very supportive. So I have personally experienced it. So I just want to mention this to everybody, okay? Because I don't think we could have got a better partner than Caspian in our journey. Okay, thank you. And I need to drop off, so I just wanted to make this statement. Thank you.
Thank you so much.
Thanks, Priya. Very, very kind of you to mention that. Oh, yeah. So next question was, is debt financing not advisable for core team building and expansion? So the shorter answer is no at early stage. But if you have the desired cash flows, if you've reached that stage where you have positive cash flows from operations, then you can think about using debt also to do things. But at early stage, for your core team building, I think you should stay away from debt unless it's like a grant that you're getting, or from family and friends. The loan that does not require structured repayments, right, where you have the flexibility. So commercial debt is not advisable at core team building stage. Yeah, thanks, Srikanth, for the explanation. Good to know that you've been working with many startups. I guess, yeah, so again, the last question was from Raghu. Debt funds for product development. Again, similar answer to what I just talked about, right? Answering Surbhi's question. Answer is mostly no, unless you really have the cash flows from business that you're confident that you can serve this debt, either from business or you've raised enough capital from alternate sources, which you're confident of managing the burn, right? Otherwise, I would suggest no. I think we were able to cover this. Thank you so much for attending. Thank you, Abhishek, and thank you, TIE team, Vijeta, Vinay, and everyone. We quite enjoyed it. We quite enjoyed answering the queries. You can reach out to us on LinkedIn or our email ID. We are there. Yeah, interest rates we did answer. I think you visit. So Ragini, thanks for mentioning